For millennia, money was a thing, a coin you could weigh, a note you could hold. Its value was tied to something physical in the world. This understanding is buried in our bones. When governments got into trouble, they turned to these machines. Run them too fast, and you get the nightmares we know. The story is seared into our memory. Runaway printing press equals societal collapse. It's simple, visceral, and it frames every modern crisis. So here is the central paradox of our age. We warn of printing presses running amok, but if you walk into the heart of a modern central bank, you will find that the most important machine is not a printer, it is a server. And the real story of 21st century money is not about paper, it is about permission. The money printing metaphor persists because it's useful, it's intuitive. Politicians use it to sound alarms. Journalists use it because the Fed added $4 trillion to its digital ledger is less compelling. But metaphors aren't just descriptions, they are frames, and a bad frame leads us to ask the wrong questions. The metaphor makes us look for physical cash, for helicopters dropping money. It suggests inflation must immediately follow, like steam from a boiler. When that doesn't happen quickly, we get confused. We declare modern economics broken. But what if the machine itself is just different? Let's be precise. The money supply isn't one thing. M0, or monetary base, that's the cash and bank reserves. M1 and M2 include digital bank deposits. When a central bank does QE, it massively expands the base, the reserves, hoping it will multiply into M1 and M2 through lending. It's not printing cash, it's creating the potential for money in digital form. The distinction isn't academic, it's the key to everything that followed 2008. Modern money creation operates on a three-layer ledger. Layer 1, the sovereign ledger. A central bank's core power is to have its IOUs accepted as the ultimate form of payment. When the Fed buys $1 million treasury bond from a major bank, it doesn't pay cash. It says, "We will credit your reserve account with us by 1 million units." It changes a number in that bank's exclusive Fed account. That's it. New base money is born. It's an electronic promise that is, by law, risk-free and liquid. Layer 2, the fractional reserve engine. The bank now has an extra $1 million in reserves. It only needs to keep a fraction. It can lend out the rest. But here's the magic. When it makes a loan, it doesn't hand over reserves. It simply creates a new deposit in the borrower's account. It types numbers. It creates commercial bank money, the deposits in your checking account. This is where the digital money supply truly expands. One keystroke at the Fed can become 10 in the banking system. Layer 3, the shadow banking ledger. Here, entities that aren't traditional banks, hedge funds, money market funds, create money-like instruments. Repo markets, where treasuries are swapped for cash overnight, effectively create short-term money. This layer is vast, global, and operates on private ledger promises. The modern money printer must address three different interconnected worlds of credit creation, not a printing press, but a hierarchy of digital ledgers, and complexity is where power hides. 2008 was not a traditional bank run, it was a shadow bank run. The shadow ledgers in Layer 3, the market for mortgage-backed securities, the repo market, froze. Nobody trusted the assets or the promises. The entire ecosystem of private money creation began to collapse in on itself. The Fed faced a problem. Lowering interest rates to zero didn't work because the problem wasn't cost, it was trust. The plumbing was blocked. They had to become the dealer of last resort. This is where QE was born, not as theory, but as emergency surgery. QE was a dual move. First, by buying toxic assets, they removed uncertainty from private ledgers. Second, by flooding the system with digital reserves, they forced down all interest rates and pushed investors to take risk elsewhere. They weren't printing money for the economy, they were performing a digital asset swap to repair broken private ledgers. This was the turning point. The central bank's ledger didn't just backstop the system, it began to define the system. The size of its balance sheet became the most important price in the world. The printer had been retired. The digital balance sheet manager had taken its place. The consequences of this shift are the story of our last decade. The new digital money had to go somewhere, but it didn't take the path the old metaphors predicted. Consequence 1: the financialization flood. Banks, stuffed with reserves but wary of risky loans, parked them or bought safe bonds. This pushed bond yields to zero, even negative. It forced pension funds, insurers, anyone seeking return into riskier assets, stocks, corporate debt. Money didn't trickle down, it trickled up the asset ladder. Consequence 2: the inequality machine. If you owned assets, you became richer in a way disconnected from labor. If you lived on a paycheck, you saw little of this new money. This is the Cantillon Effect in digital HD. Those closest to the central bank's keystrokes benefit first and most. The system didn't just create money, it created inequality by design. Consequence 3: the moral hazard ocean. If every market correction is met with more digital liquidity, it incentivizes ever greater risk-taking. It privatizes gains and socializes potential losses. The market is no longer a discovery mechanism. It's a game whose most important rule is that the central bank's ledger stands behind it all. This isn't capitalism or socialism. It's something newer: central bank-driven financialism. The printing press metaphor is comforting. It implies a limit. You can only run the presses so fast before they break. It's a physical constraint. The digital ledger has no such inherent limit. Its constraints are political and psychological. Will it cause inflation? Will it destroy currency credibility? These are questions of trust and politics, not mechanics. We have traded the visible, understandable monster of the printing press for the invisible, complex deity of the digital ledger. One was a tool of desperation. The other is a tool of permanent, technocratic management. This is the great monetary evolution of our time, hidden in plain sight by an outdated metaphor. We abandoned the printing press. What have we built in its place? And who controls the enter key? This isn't about conspiracy, it's about comprehension. The first step to understanding the economy of the 21st century is to delete the old image from your mind. We've seen money evolve from a physical object to a digital permission, from gold in a vault to a keystroke in a server room. The burden has shifted from the strength of metal to the strength of trust in code and institutions. That enter key holds more power than any stamp or press ever did. A single decision can ripple through the entire global system, touching your savings, your home, and the price of bread. True wealth is no longer just what you own, but understanding the ledger on which it's recorded. The roots of our system, trust, productivity, and law, must support the digital branches of currency and credit, or the whole tree may falter. This story connects the scribes of old ledgers to the traders at modern desks. It's a continuous thread of human agreement on what has value. And now you see it. The reflection in the screen isn't just light, it's a new awareness. Money has been a barter token, a gold coin, a paper promise, and now a digital signal in a network. Each form a prism splitting the same light of economic energy differently. The bridge between state power and market dynamism built on this digital ledger is both essential and fragile. The complex equations of finance are not abstract. They layer directly over the simple reality of a family trying to buy groceries. The theory must serve the reality. So what is value today? Is it the weight of gold or the certainty of a data stream? The scales can balance,